Okay, thanks so much. I think it's already 9 o'clock. I think we should start. So thank you everybody for attending today's strategy session. Um, we've got a lot of feedback from our prior strategy sessions that it was a bit too long and there were also technical issues. So to try to resolve this, all of us actually gathered in our City Hall office. And secondly, we actually cut back the number of slides. I think we used to have like a 80, sometimes 100 page slide deck. So now we cut it to 50, and hopefully we will take it slower, and also we will have more time for questions and answers. I think that was the feedback, and we treasure everyone's feedback, and we will try to accommodate. So my name is Paul, head of research. Together we have almost the whole team here, all our analysts. So feel free to ask the analysts any questions. Anyway, we should start. So what we did was for the second quarter strategy, it is in reference to the report that we released. You know, our strategy reports tend to be short. We don't want to kind of dwell too long. We try to just focus on the key points. And for us, how we see the situation right now, as the title suggests, is that the music is still playing. I mean, this is not for me. What we're trying to say basically is that despite all these worries of inflation and interest rates, the Fed is basically saying even if there's any interest rate rise, it's going to be transient, it's going to be temporary, and you can just keep on dancing, I guess, since the music is still playing. I mean, that's the gist of the title. That's why we had it that way. Our report was released on Thursday. So let me just go on to the next slide. Okay. I know nobody reads the disclaimer, but I think just to good to just refresh for everyone. I think the disclaimer basically what I just trying to tell everyone is that no, we rely a lot on third-party reports. Number one, no, these are all our views and opinions. And number three, again, no, if you do seek a financial advisor, no, because this is just a general commentary and may not suit your investment objectives or financial situations. We just wanted to get, I know most people don't read, but I think it's just good as a reminder of the disclaimer. Okay, so we just move in proper to the presentation. We will start off with just a review of what happened in the first quarter in context of the Singapore market. The reason why we had this picture is essentially for the first time after quite some time, the Singapore market started to grow, and at least if we started to make something out of our savings, there's some growth or some as reflected for the plan. There's some returns that is received at least for this quarter from the Singapore market. Okay, in terms of the slide that you see here, sorry, I'm just trying to hide the top here. Okay, in terms of the slide that you see here, for the returns, you can see that this is referring to first quarter returns. So we actually did very well. The Singapore market performed really well. This is in US dollar terms, but in Sing dollar terms, the STI actually was up 11%. And when you compare to other asset classes, we actually strongly outperform. So let me just run through very quickly. The column on the right is the REITs. So you can see that the REITs didn't perform well this quarter, I think because of the defensive nature, and the cyclicals did well. We also outperformed the MSCI Asia Pac ex-Japan. For those who don't know, this is basically, you have your Alibabas, your Tencent, all inside here. It is all the major Asian markets excluding Japan. Then, of course, we all know S&P, so we even outperformed the US markets, which is rare, sadly. And we obviously outperformed the bonds because of the when interest rates rise, then obviously bonds will underperform. You can see that we use ETF, so we're not using some fictional interest rate US 10-year bond. We actually took some of the ETF performance to give a real reflection of the actual returns. If you want to know details of the ETF, it's all at the bottom. Sorry, it's a bit small, but some of these are like your LQD bonds, LQD ETFs, and then we also outperform gold. Rising interest rates obviously will kind of affect gold prices, and of course this is the famous GLD ETF, and we also the one asset class we could not outperform, which was the commodities. Surprisingly, actually, it's not very easy to find a commodity ETF that's spread out across multiple commodity types. So commodities did well in line with the theme of cyclicals outperforming the defensive stock. Well, anyway, that's in the past. I'm not going to dwell too much, but it was a good year for us, at least for the first quarter. On the next slide, we wanted to show the which sectors outperform. So it's pretty obvious from the left. The sectors that outperformed were the cyclical stocks like shipping, transportation. Shipping actually mainly refers to Yang because Yang is such a huge weight on the shipping sector. Now, conglomerates did well, I think we all know, because of the privatization by Jardine Strategic. And then transportation is purely because of SIA and related stocks. Commodities is really the Wilmar effect here. What underperform is you can look on your far right in bit and on the rate. So you can see all the REITs underperform. Healthcare, I think we know, is actually the healthcare, the glove sector is under healthcare. So that pulled down the index. But in terms of as you can see, all the underperformers were all the various types of REITs. Another way to kind of dissect performance is if the STI is up 11%, so anything from property onwards actually underperformed the market. So the deep cyclicals, you could say, were the key outperformers for the STI, at least in the first quarter. So in terms of our final slide on the Singapore market, we always like to just see, so what stocks actually did outperform. STI component stocks, SGX has 700 stocks. I'm not going to show everyone, but we just wanted to focus on the STI. And if you look at the blockbuster gains, which is the top left, you can see that the big gainers were the banks. I think probably this is one of the best performance in a long time, because this is just over 3 months. Then again, like we mentioned, the deep cyclicals, the one in the middle, the top, the Yang Zhejiang Jardine. So these were the other big performers. And consumer was mixed actually. You can see they underperformed at 11% in the STI. And of course, banks, because of the 40% weight on the STI, will just put the whole index up. The losers were the REITs at the bottom left. And again, the REITs only 2 REITs kind of had any gains out of the 6. And property was mixed. CapitaLand did well, but not everyone like UOL. Okay, and that's it for review. This is just to give you some flavor of what happened before we move forward. So the next segment, we're just going to talk about economic conditions. We're not going to forecast. We're not an economist, which is maybe you're taking one additional employee that you don't need. But we're just going to talk about what are the current conditions. And the current conditions is there's a lot of liquidity, and we're getting a big economic bounce. There's huge economic momentum in global economies. So we just have 3 slides on economy. Again, we're not trying to we do not want to do too much macro here. So the first slide, as you can see, we usually use this just to get a barometer of manufacturing activity. So if you just focus on the global, which is the blue chart. So for those who don't know, just a refresh, PMIs are basically surveys that are given out to all the purchasing managers or all the factories in very layman terms, and they will actually explain to you how our conditions, and if it's improving, then you can see the directionally the lines will go up. So like above 50 means it's expanding. So you can see that not only are we getting a V shape, but we are actually higher than the pre-pandemics, the 2019 levels. So the first bullet point, the PMI is higher than the pre-pandemic, which is if you just focus on the blue line, especially, which is the global line. Eurozone, the green line actually is even far better. It's like a multi-year high. And the good thing is that this is even before the second bullet point. This is even before we're getting the Biden 1.9 trillion stimulus. So you can expect the trajectory of the PMI to accelerate even more, because we're not even feeling the effect of the stimulus, less lockdowns and so forth. So global growth can only accelerate from the current levels. And we also expect second quarter, which is, again, April to June, should be a really blowout quarter for global economies. Because don't forget, a year ago, because most times you measure year on year. So last year, same time as we're in the heavy lockdowns, China lockdowns, there was a lot of factory disruptions. A lot of factories in China had to close. So you're going to get this big blowout in base effect. So second quarter numbers will be even stronger, because the prior year, when you do the comparisons, because there was like many economies were in virtual lockdowns or paralysis. I need the fourth bullet point. I need just a sarcastic comment, because we think this is K-shape, because you always watch, I guess if you watch CNBC, some would say K-shape, Y-shape, L-shape, all kinds of shape. But I guess although the consensus was V, and some people just couldn't accept that it's going to be a V-shaped rebound, but this is pretty obvious, at least for the manufacturing activity. If we move on to the next slide, we also wanted to track how imports. So these are the imports for the top 5 largest economies. So we took the import growth of US, China, Japan, Europe, and we wanted to see how is that tracking. A simple way to look at this is that if all these big economies are importing more, obviously it's good for global trade and good for global economies. So what we see is that you can see from the chart here that it is rising and it is accelerating. It should be accelerating because we only have up to January data. And the second bullet point, another way that we track is the amount of imports coming into the LA ports, which is this is a way to gauge the volume. And you can see that the second bullet point, we are enjoying like record container volumes coming through LA ports. And you know, US is not a major exporter, so these are usually a lot of consumer goods, and it's just a barometer that the US consumer is in great shape, and also 32%. These are record level volume imports. The third point, if you want to just as a flavor of what's going on in the global trade, if you look at container rates, SH means Shanghai, LA means Los Angeles, obviously, and then SH means Shanghai and RO means Rotterdam. So the container rates, if you want to ship containers, I think those who are in manufacturing will know this. If you want to ship from, let's say, Shanghai to LA, the rates are up 2 times. It's doubled from a year ago. And it's also doubled, it's over more than tripled from Shanghai to Rotterdam about a year ago. So I guess if glove industry is doing well, the containers could be doing just as well, because the rates are all like doubling or even tripling from a year ago. If we then the other phenomena that's happening in global economies, this will be my last slide on economic conditions, is that there's a big reflation going on. And what we see is that commodities are at multi-decade highs. I mean, pick your commodity. It could be copper, palm oil, whatever. Some are multi-decade or even all-time highs. So that's happening around the world. And you can see that in the blue chart. So this is all the way to 1980s. You can see that it's bouncing back up to likely even possibly even breaking records. The only thing pulling back is of course oil prices. The import, and of course the red chart here you see is basically the US residential prices. As we all know, there was a housing bubble in 2006 because of leverage, but if you look, just track on prices, it's like far ahead of the 2006 levels. And the second bullet point is, this is important because when prices rise, you're going to get the wealth effect. And of course, this will be another impetus for the consumer, the US consumer. The inflationary pressure is pretty obvious, I think. But again, we have our Fed telling us, don't worry, it's just temporary, at least for this year. And just to dial back home, even our Singapore property, I think Natalie will dwell later, as we all saw in the newspaper, Singapore property prices are at all-time highs based on the recent URA property price index. So anyway, these 3 slides is just to show you, we're done with the economic condition, not dwell too long. The problem with doing economics is that you can say a lot, but there's no decision of it. But so we just wanted to just let everyone know what is going on. So the 2 points is that global growth is accelerating and you're seeing reflation everywhere. So if we now move on to macro themes, okay, the main theme right now would be the shape of the pandemic, and what we can see right now is that we actually did well. I think up to February, if you focus on the blue line, the number of cases. So this is the daily new cases, and you can see that cases hit the lows in February. But then what we are getting now is the cases are actually going back to 2-month highs. And then what we see is that there's a rebound in certain countries. And if you, sorry, it might be a bit small, you can see that even Brazil, which is the green line, is actually even higher than the US. And Southeast Asia now is even higher than the US in terms of new cases. The reason this chart is important, and we actually track it every week, is that this actually will determine the shape of global economies. If we get another big resurgence, obviously we're going to face risk of lockdowns. And that's why the key thing here is just that the shape of the infection is still unclear. So we can't for definite we can't definitely say that pandemic is behind us and all everything is over. So this is just a reminder that we're actually undergoing another round of I don't know, you can hopefully it's not a fourth wave, but you can see the surge right now, especially in Europe. But the good thing is the US is kind of stabilizing. Okay, if we focus on Singapore, we can see that the cases in Singapore is doing well. We were actually close to breaching our record of 15 days without a community case. We hit 13, but then after that we had a few cases. So in terms of the past 1 week, there were 3 community cases. Sorry, let me just explain the chart. This chart is basically community cases, the new cases, and you can see the number 53 there. Hopefully that never ever happens. But we were having like 50 before we had circuit breaker. The number of cases, community case per day, on average was about 53. So I think obviously right now we are like we only have like on average 3 over 1 week. So obviously we are far from it. That's one way to read this chart. Before we entered phase 1, we had like 5 cases per day, 7 cases, then phase 3.1. So we are just back to the 0.1 per day. One way to read this. I think we all know some of us could have already, and we are already undergoing the vaccination process. And so what we're just trying to say is that for Singapore, we are in much better shape compared to many countries. And the key thing is that the 2 last points is that we are reopening further, loosening gatherings, and of course, more people, the workplace also conditions also relaxing, and more people will be going back to work. I think it's pretty obvious, so we won't go too much into it. If I move on to the next slide, because just a very quick, because vaccination is underway, so we also track the level of vaccination globally. So to read this chart is that we have January to December. So what we're saying is that if the current vaccination rate progresses and we measure it on a linear basis, what would be the amount of people vaccinated, fully vaccinated, of course, by year end? So that's how you read the number. So by year end, roughly there could be about 900 million people globally that's vaccinated. In US, about 300, not 342, because US population only like 320, 330, but just to show you the level if we extrapolate it. So so right now, if you want to have a 75% herd immunity, of course it can be 80, 90. I mean, nobody truly knows the magic number, but if you just take 75, it would take the world at least maybe 6 years based on the current level of vaccination for the whole world to get vaccinated. But the good thing is, I'm not sure what they did, but they may not have contained the virus well. But in terms of vaccination, the US is far ahead of everyone. I think even by June, they probably could get most people vaccinated, that 75%, even by June. And by this year, provided everybody wants to get vaccinated, they definitely can get everyone vaccinated by this year based on the current trajectory. So the US has done amazingly well in terms of vaccinating everyone. But the key thing right now is that the real test is that once everyone is vaccinated, will there be cases? So that is still the unknown. If everyone is vaccinated and we still get a lot of COVID cases, then that's going to be a major tail risk for all of us. Then what it means that the vaccination doesn't really work. So of course it's a really low probability, but it's something that we need to monitor. So as vaccination goes into more advanced stage in the US, it's important that the number of cases continue to fall. As you know, the latest numbers in the US is that the number of COVID cases is rebounding. So there's something for us to track. The third point is nothing much. It's just to show you how we calculate this. This is just, we just take the average and we just kind of extrapolate it to kind of get the number. So the US is amazingly fast. This year, the next few months, they're going to vaccinate everyone. Okay, the next theme that we have is interest rates. So of course, interest rates is the big talking point right now. Will the interest rates, will interest rates derail the equity rally? Surprisingly, actually even surprised me that actually when interest rates rise, equity markets do rally. So just to, I know this chart's a bit complicated, but let me just explain. The beige columns that you see, those are periods where interest rates rise. So the interest rate is the red line. Just remember red because we don't like it, so we put it red. So you can see that in 1999, when interest rates were rising, you can see from the red line, the equity market did rally, as you can see from the green, I don't know, green box that or green circle that we did. Likewise, you can see maybe 2003, 2004, even though interest rates rise, you can see that the equity market did rally. You see in 2009, 2018. So actually, historically, when interest rates start to climb, you actually get like a 30-40% return in the equity market. The only time it didn't happen was in 1993, 94, and that's because the Federal Reserve kind of surprised everyone by raising rates, and then of course they knock it back down. But that was when the market didn't perform because there was a big surprise by the Federal Reserve that rates were rising. But in most times, when interest rates rise, even in the 2001, if you see the last beige line, you can see that even during this time right now, the S&P is already hit, actually it's already crossed 4,000, but this is up to 31st. So you can see that rising rates actually coincide. And one of the reasons is because rising rates usually refer to a improvement in economic activity, and that's why equity markets rise. The second last bullet point, just that the last time we got you can't really see, but in 2016 we also got a big surge in interest rates, and the market continued to rise because of the Trump tax cuts. And also the real thing that we all should worry as an equity investor is recessions. So we don't have it in the chart, but recession is the one that really will kill any equity market. That was when you really enter into a bear phase, not so much rising interest rates. Okay, the second thing, not to dwell too much on this, right? The second reason why we are not so worried, at least right now, for the rise in interest rates is that even at the current increase, it is still far lower than the previous periods when we got a big surge in in GDP in the US. So just to understand this chart, sorry, it's a bit complicated, but the bar chart shows the GDP in the US. The red chart is, of course, again, we all don't like this chart, so it's interest rates. And the yellow is real interest rates. It's more for those people who are more academic and want to measure real interest rates. But the message here is that whenever the US GDP goes above 5%, that's when we had like stellar growth in the US. Interest rates have ranged from 11.6, as you can see from the table on the right, to the lowest was about 4. So right now we're only 1.7, and the GDP is about 6.5. So interest rates are still very, very accommodative. And the interest rates pre-pandemic was about 2. So even if rates move to 2%, it's very unlikely to kind of stifle economic growth in the US. And I don't think, and logically speaking, if rates move from 1.7 to 2%, I don't think that's going to affect a lot of people's decision making to not invest and so forth. So that's why, if you take into context, the current rise isn't very alarming. Even if it goes to 2, it's just back to pre-pandemic levels. Considering the huge growth we're expecting, 6.5, and the 6.5 comes from the Federal Reserve. It's not some economic forecast. So they tend to be a bit more conservative. So that's why. So these are the two reasons why we think rising rates will not stifle growth, and it should not be a worry for equity investors. Okay, again, this is going to be, I think this should be my last chart on this economic themes. So this is a very important chart. This is probably the most important chart. And if you can forecast this chart, you probably can get very wealthy, because this is going to be the inflation chart. So the blue line basically is the inflation, which the Fed measure. PCE is just a fancy term for another way of measuring CPI. But so the blue chart is inflation. The red line that you see across is the target. So for the Fed, we explain later. So this one, the blue line must not cross the red line too much, and then otherwise the Fed will start to raise interest rate. Okay, so the question right now is, what will make the Federal Reserve raise interest rates? Okay, so there are two conditions. These are from them. This is not from me. I didn't make this up. So firstly, you need to be moderately higher than 2%. Okay, don't ask me what's moderate. They never say. But if you assume moderately is 12 months, you can see that the orange line, sorry, it's a bit academic, but you can see from the orange line, we hardly touched 2%, or I don't think we will touch it for the last 10 years. Okay, so you need to be higher than 2%, number one. Then number two, for the rates, Federal Reserve to raise rates, you need to get maximum employment, which is about, no one knows, again, they never tell you the exact number, but it's expected to be 3.5 to 4, and right now unemployment is 6%. So we are far from reaching these goals. And even if we do reach, so assuming we do cross that magical red line that will worry investors that the Fed will raise rate, even then the Fed says it's going to be temporary. So don't worry even if it crosses the red line. So the Fed is just that. So the way we translate it is that the Fed is just saying, the music is still playing. So don't, of course, someone to fight the Fed and say that rates will rise. But for us, it's going to be, unless inflation raises to 3%, then you start to see Federal Reserve react. Otherwise, even if it crosses 2, they're just telling you, don't worry, it's just short term, and they will not move tighten monetary policy. So all these are important. The reason why we delve in it, because every month when you get inflation numbers or employment numbers, the bond markets are going to gyrate. They're going to be volatile, and there could be a lot of volatility. But for us, we're just trying to tell investors it's going to be a long stretch before at least this year, we unlikely the Federal Reserve will move interest rates. So we should not be too worried about any tightening of monetary policy by the Federal Reserve. Okay, I think that's it for me. Next, we'll have 2 slides by our technical chartist, Weiren. He will just give you his read on the STI, and he'll give you his top pick on terms of the technical point of view. Hand it over to you, Weiren.
All right, thank you very much, Paul. So for the next slide, basically today I'll just share about the outlook of the STI. So the next slide. Yeah, so I'll be sharing the weekly chart first of all because I think I'm going to share about the quarter, and then I'm going to try to use the chart to predict by end of 2021 where's STI going to hit to. Of course, there will be some minute changes within during the period from now to end of 2021. So first of all, just a clear picture. I think STI on the larger time frame, it has already broken out of the downtrend, the immediate downtrend line from since 2018 up to March 2020 last year. Okay, so you can see that it has after it breaks the downtrend line, it has made a series of higher high, higher lows, higher lows, and etc. But however, I think if you look at that, we last week, I mean, a few days ago, before the market closed for the Good Friday holiday, you can see that there's a weekly pin bar below resistance zone 1 over there. So I expect some form of like pullback into the support zone. Okay, once the support zone it is likely the price will be well supported by the support zone between 3020 to 3062.15. You can see from what I say in my slides. Okay, don't be surprised that it can be well supported at 3100 as well. Okay, so the next thing is what goes after that, after the correction. Okay, so I think the price is going to okay, so price is going to form a rebound, and then is going to test the resistance zone 1 at 3177 to 3231.97 once again. All right, and then once that level is broken, and then I think that is highly probable, then we can see that by end of 2021 we will see the target price at 3410 and by end of 2021. All right, but next year onwards, I'm not very sure. Okay, so but do take note that the STI, the high or STI still remain at the highest level, is still remain at 3008, and then the immediate is at 3006. Okay, so by breaking that level, then we can conclude that STI has formed a new high. But sad to say, I think STI has still a lot of room to improve to reach a new high again. All right, so for the next slide. Okay, so we be sharing my next pick. I'll be Nanofilm. Nanofilm made its debut on last year, October or November. I can't remember the date. Okay, so it basically after debut, it actually formed a very high rally thereafter. Okay, so it means that it keep on growing from $2.50 all the way to $5.20, opening 100% growth. Okay, but if you look at that start of like Jan this year, I think it formed like a downside correction. But I think price is on the way to make a new high. So you can see from there why, because of the falling wedge. And then after that, price, secondly, I think first I think price has really broken out of the falling wedge. Okay. That's the first point. And then second point, if you do the immediate resistance level, we box it out with a range. Last Thursday, before the Good Friday holiday, price actually has broken out of the immediate resistance level at $5.10. And then it's on the way to meet the target resistance at between $5.39 to $5.58. Okay, so expect some form of pullback, and then after that, by end of the second quarter, we'll be looking at $6.05 to $6.41 by end of second quarter. Okay, so what's the other thing? If price fails to face strong resistance at target resistance zone 1, it may have a tendency to pull back, have a directly pull back to the support level zone. Okay, that which I mark out in chart between $4.30 to $4.42. All right, so that's all for me. I'll pass my time back to my colleagues. We'll be sharing on the macro updates. Thank you.
Yeah, thanks, Biren. So next we were going to run through our sector views, and we will start off with banking sector for our banking analyst, Wee Kwang. Over to you, Wee Kwang.
Okay, thank you, Paul. Okay, so for the banking sector, we know that the banking sector is embarking on a recovery phase. So if you just take a look at the chart on the left-hand side, that's where what you'll be seeing for over the next 2 years. So you see that the bar chart, which is their PATMI, over the next 2 years is likely to increase compared to, and this is the main reason for this is due to the lower allowances that will be provided for by the banks over the next 2 years. If you see that, that's the orange line. So the orange line is going to see a very sharp decline in 2021 and 2022. And so the reason for this, you can see that in 2020, the amount of allowances that they actually provided for during the peak of the COVID-19 situation in Singapore is almost double that during the oil crisis in 2017. Yep. And so what they do see is that this amount of allowances that they have provided for will be sufficient for any credit deterioration in the coming year should things turn for the worse. And that will be one of the reasons why they will just taper off their allowances from now on. That's the indication that we get from the local banks. And secondly, we also see the second point, you can see that the fees and commission, we are expecting them to start growing with the better economic conditions coming into 2021. And some of the underlying things that we see is also that the loans growth has been seeing improvement compared to before the COVID-19 situation where loans have been declining. We see that there has been already 4 consecutive months of loans growth in Singapore. Both the consumer and the business loans are growing healthily. And even for the consumer loans, it is actually a positive year on year, which is something that we haven't seen in a while. And the fourth point, if you take a look at, of course, there is some people talk about interest rates risk. For the banks, it will be a good thing, right, for the interest rates to increase. And of course, we exited the first quarter with interest rates being higher than the average we saw in the first quarter. However, if you actually compare it to the 2020 average, it is still below the average by about 20 to 30 basis points. And if you take a look at historically, it is still below the 5-year average in terms of interest rates. So definitely margins-wise, they will still face some pressure, which is why we see that in 2021, the PATMI of the banks will start to recover, but probably not be back to where it was at in 2019. That was pre-pandemic. And the second last point that I have for the banking sector is that there is definitely a re-rating catalyst out there when the MAS actually lifts their dividend restrictions for the banks itself. So this is supported by their strong capital position that the banks have built up. So even during the pandemic last year, we saw that the CET1 ratios have improved. It is currently now standing at about 14.6%. And this is much higher than their ideal operating level of about 13%. So all in all, we feel that we are maintaining an overweight in terms of the banking sector. And we see that in terms of yield attractiveness and some of the the capital gains that they might see, it is still quite positive for the banks. And that's it for the banking sector. I'll now be talking about the healthcare sector. Next slide. Okay, so for the healthcare sector, you can see the chart on the left-hand side basically see some of the demand across the various healthcare services in terms of public and private hospital, specialists, as well as dental clinic. Of course, we see a very strong rebound year on year. In terms of hospital admissions, it is still slightly lagging behind. However, for specialists and dental services, it has actually normalized. Of course, year on year, you see a very huge jump because I think starting of last year, by the time about February, it has already started to decline with the start of the COVID-19 situation. And if you actually take a look and you put it into context, this recovery to almost a pre-pandemic level is taking into consideration that there have been no foreign patients for a while now due to the travel restrictions that we see in Singapore. And currently, the stance for foreign patients is that MOH actually can grant they can actually grant entry into Singapore for some of the treatments that are actually important, but this will be initiated by the doctors themselves. So we will start to see a slow return of foreign patients into Singapore, and this will help to boost the healthcare demand even further moving ahead as the vaccination program start to roll out. And thirdly, we know that during the whole past year, there has been an emergence of new businesses. So we see things like COVID-19 testing related services, and some of the healthcare counters that we cover, like Raffles Medical and Q&M, they actually have come up with like testing laboratories that actually enter into government contracts. Of course, we do not know the exact details of these government contracts, but they do help with the testing efforts that we see, and this will help to pace their earnings their income over the next 2 years, as we think that the COVID-19 situation will be here to stay. We need mass testing capacity for the resumption of a lot of these large-scale events that we see. And in terms of year-to-date, when we talk about how the surging demand, if you compare it just by the end of February in 2021 compared to the first 2 months in 2020, the dental is already up 5% year-on-year, while the specialists, they are actually up like 16% year-on-year. So we see this strong demand will continue moving forward. And that's it from the healthcare sector. Now Natalie will be talking about the property sector.
Thank you, Rico. Good morning, everyone. So just starting off with the property sector. First of all, okay, we start off with the price performance for the property sector. First of all, drawing your attention to the chart, you see that even in 2020, property prices were moving the upward trajectory, especially in FY21, which was first quarter of FY21, which was released earlier just last week. You can see that overall for all the private estates or private residentials classes, the price index actually improved by about 2.9%, and this brings the year-on-year increase of property prices to about 6.2%. Okay, so now just this higher or this 6.2% increase year-on-year actually increases the likelihood of more property cooling measures to hit the market. So overall, the number of unsold units actually fell by about almost 20% year-on-year. This was the number that was previously an overhang for the property market, and a lot of market watchers were actually very concerned at the start of 2019 that there was a very large inventory outstanding. So this has fallen 20% to about 24,000 as at 4Q20. Okay. So the demand for private property actually comes from upgraders, and in this coming year, we actually expect additional 20,000 HDB units that will achieve their minimum occupancy period, which is MOP for short, where they can actually sell their HDBs, or rather they're built to order HDBs. Yeah. So another tailwind for property is that the comparatively lower interest rate environment, of course compared to previous years, presents an attractive opportunity for some of these potential home buyers to consider making this large ticket investment. Overall, we see that the developer stocks are still trading at a relatively attractive 40% discount to price to NAV. So that's all for property sector. We'll move on to the REIT sector. So for the REIT sector, REITs are like dividend stocks, or rather, investors will actually want to receive stable dividends from the counters. So they have an inverse relationship with interest rates, and so the REITs, as Paul mentioned earlier, did not have a very good start of the year due to the rising interest rate environments. So just to start things off, draw your attention to the little table at the bottom right hand side of your screen. You see that at the end of March, interest rates were actually rather the 10-year bond yield was actually at 1.63%. So this is actually a 70 basis points. It's actually 70 basis points higher than what it was at 4Q20. That said, if you compare it to historical levels on a 5-year time frame or a 10-year time frame, the present interest rate is still lower than what we saw 5 years ago and 10 years ago. However, because the interest rates does have a negative, rather inverse relationship with the REITs, we see that in the graph on your left, the light blue line, which is the price index for the REITs, the price index for the REITs, you can see that actually there was not a substantial upward movement. It was trading largely sideways. So, and this was also due to some of the rotation into cyclicals, as some investors dropped REITs from their portfolios and decided to move to holding cyclicals to benefit from the upturn. Okay, in terms of dividend yield spread, which is the dark blue line, which is bounded by the green and red lines, this is the dividend yield spread. So it's the dividends that the investors will receive after minusing the 10-year bond yield. So in a sense, it's like your risk-adjusted return for holding on to the REITs instead of a safer investment like a 10-year bond. And so this dark blue line, you see that actually it has moved below the lower green line, and it's now trading at about -2 standard deviation, which is in a way you can say that it's a bit expensive or unattractive as compared to how the dividend yield spreads has been in the prior years. That said, for FY21, the DPU yields that we are expecting, because this dark blue line is actually on a historical basis, but looking forward, we are projecting DPU yields of about 3.6% to 9% for the REITs under our coverage. Of course, it's a very large band. So 3.6% is for Capital DC, which is on the more expensive side of REITs. And then the higher yields of about 8.9%, that one is for Manulife. So it's overall, there is still some merit to holding on to REITs, even in this interest rate cycle. Okay, so just moving on to the DPU impact, which is a distribution impact from this rising interest rate environment. So just the graph on your right hand side, you can see that it's under the worst case scenario, which is your dark blue bar, assuming a 100 basis point or 1% increase in interest rates, you will see that if the REITs did not employ any hedging, they will receive a 6 to almost 30% hit on their DPU if interest rates were to rise by 1% and they had not maintained in a hedge position. So this is like your worst case scenario. But because the REITs do employ a relatively high level of hedging, it averages about 70% across the REITs. Of course, there's a range to it. But because of this hedging and the sort of well-balanced debt maturity profiles of about anywhere from 3 to 7 years, the impact from rising interest rates will not be felt in such a large way, especially in FY21. It will be a gradual impact. So we can see that under the various hedgings that the REITs employ, they will actually be impacted by about 0 to 16%. So 0%, of course, is LREIT and LREIT, which is Land Lease REIT, as well as iREIT, because they have fully hedged their interest rates. And then to varying degrees, the other REITs they have hedged between 30% to 70%. Okay, so that's all for the REIT sector. No, sorry, that's not all for the next slide, please. Okay, so outlook for the REITs, where we see the REITs, how we see the REITs performing in FY21. So from 2021 and 2022, you'll see a resumption of DPU growth. So we just start off with how we did last year. So in the graph that you see, the first cluster of charts is the performance for FY20. So of course, largely negative except for industrials that managed to eke out a small positive of 0.8%. Otherwise, in terms of DPU growth, of course, hospitality was the largest hit, and then followed by your retail and your diversified REITs, and then to a small effect, the office REITs. So this is for the DPUs for the counters under our coverage. So in FY21, we will see that of course, for the sectors that will register the largest DPU growth are the ones that were most impacted in FY20. So it's your hospitality and your retail sector. And then the rest will also exhibit a DPU growth, but to a smaller extent. Okay. So in terms of how the prices are currently as compared to pre-COVID levels, the table at the bottom of your screen, you see that healthcare and industrial, they are currently trading at above pre-COVID valuations, about 3 to 7% above. Whereas hospitality is still the laggard, down by about almost 26% in terms of price. And then your retail, commercial, diversified, somewhere straddled in the middle, still down by about 13 to 17%. In terms of subsector preferences, we prefer the retail and the industrial subsectors. So first of all, the retail subsector, we maintain our overweight call on the retail subsector. First of all, of course, benefiting from the increased consumer spending in Singapore. So for January, the retail sales index was down by only about 3.8% year on year. And this is despite the absence of tourist spending, which accounts for almost 30% of the retail sales. And that's it. Of course, as international trade borders, as more events start to happen and take place, as we resume, as we move back towards a normal lifestyle, then we can see an increase in purchase triggers, which will of course lift the discretionary spending. And not to mention, we look forward to the return of tourists somewhere in late 2021. For the industrial subsector, we are seeing quite encouraging economic data. So the February PMI was in its 8th month of expansion. The Nordex was also positive at 4.2%. And of course, we see bright spots for the logistics, high-spec and data center classes. And of course, these three asset classes are the beneficiaries of futuristic trends like your e-commerce as well as your higher cloud and 5G adoption. In terms of office, we are neutral. This is because, of course, despite having relatively supportive supply conditions, the supply is actually below the 10-year average of supply in the market. And additionally, we have almost 1.2 million square feet of space that will be taken off the market, and that will reduce the amount of supply in the market and also provide demand from relocation. And this is supportive for the office sector, but also we are still cautious due to a potential right sizing from corporates that may take place. And occupancy remains high for the office sector, still above your 90% levels, even up to 95% for some of the REITs. However, we see that, and we actually look forward to more demand from overseas tenants as Singapore still shines very brightly as office location, especially for regional headquarters. In terms of the hospitality sector, we are neutral, and this is because there has been some price improvement over the last quarter itself, and that has actually taken away some of the upside for the hospitality sector. The hospitality sector still faces a relatively long recovery to pre-COVID levels. Various tourism boards actually they're forecasting a 2 to 3 years in recovery to pre-COVID levels. But that said, of course, the silver lining is that major economies are currently leading the way in immunization rates, with UK taking the lead at almost 50% of the population being immunized. And then coming in second would be US at about 43%. So that's all for the REIT sector, and I'll pass the time now to Terence.
Thanks, Natalie. So we cover, for the utility sector, we look at India and China. And we very specifically, why we look at India and China is because Sembcorp Industries have, you all may be wondering about that. The reason is because Sembcorp Industries have a very heavy weighting and exposure to the India and China markets. So to look at the utility sector, we look at the PMI in India and China, and for the last quarter, it actually stayed flat at 56.4 and 51.9 respectively. So you can compare this to how it was in September 2020, it's 56.8 and 51.5 respectively. So you can see it's rather flat. Of course, the PMI started to trend much higher in the first quarter of 2021 for both India and China, but for India, we start to see in March, because of the resurgence in COVID-19 cases, the economic activity has kind of stalled a little bit, especially near the end of the first quarter. We also look at average plant load factors. Plant load factors is the plant utilization rate is at 57.1% capacity in India. This is versus pre-COVID, and so China is at versus pre-COVID 85%. So you can see the chart here on the left and the left-hand side for India electricity production. You can see it's starting to recover a little bit, but not as fast as the China electricity consumption at the bottom. So overall, we see that China has seen a much faster recovery. For India, the outlook for second quarter will remain uncertain because of the resurgence of COVID-19 cases. In this sector, we are neutral on Sembcorp Industries because the valuations, the price has run a little bit ahead of our valuations. Yep. So that's all for me. I'll pass on the time to Paul to cover the rest of the sectors. Paul, over to you.
Okay, thanks so much, Terence. I'll move on to the next sector, which is, just hide the video panel. Okay, which is land transportation. Actually, these days with Google, you don't really need LTA numbers. So basically, this is the mobility trends of Google. So actually, Google tracks the movement of everyone, which is a bit scary too, and especially important to turn off your Google Tracker after 10:30, since we're not allowed to consume alcohol after that. But anyway, so if you can see from this chart, the green line basically means transit. So this is the amount of activity of people using the trains and buses. And also the blue line is retail and the red line is a workplace. It is quite accurate. As you can see, when we had the circuit breaker, the far left column, activity just plunged, and Google Mobility kind of is consistent with that. And when we had phase one, which is P1, the reopening, you can see that the activity actually bounced back up, and likewise for P2. But when we had phase 3 opening, you can see that activity kind of just went sideways, and that is what we are facing right now. Of course, when Chinese New Year, everything just plunged. So it's a good chart to monitor, but at the same time, it's a very scary chart to monitor because they actually know what all of us are doing. So anyway, the first bullet point is that transit or real activity is still below 20-30% below pre-COVID. So if you assume zero is pre-COVID, you can see from the green line, we are still maybe like 20% below that levels. But we do expect some improvements because right now, as we move into 5th April, where the workplace restrictions have been, where workers can move from 50 to 75% back to office. So we expect the amount of activity in the transit to improve, and that should help like someone like SBS Transit or Comfort because they have the downtown lines and so forth. Just out of interest, retail is sideways. So our rating is overweight for land transport. We'll explain why. But essentially, there's only one stock here, which is either Comfort or SBS Transit, and they're both the same anyway. If we move on to the next chart, which is air transport, if you do know anyone, you can see from this chart, it's pretty sad. There's really nobody coming to Singapore. And if you know anyone, please ask them to come over. So if you just want to look at the details, so we used to get like 50,000 visitors a day, but right now we're only getting like 700. So another way to read this is that for us to one day of arrivals, 50,000, it now takes us almost 2.5 months or even 3 months to reach that number. What we get in one day in the past now takes us 3 months to gather. So you can see because of the travel, the restrictions and so forth, the amount of arrivals is just insignificant, like a 99.99% drop. Of course, the second bullet point is the travel bubbles are not working so far. We will probably get some passport vaccination. The fourth point is quite important. It's just to remind everyone why arrivals are important for us. It hurts telcos, we'll explain later, because of the roaming revenues. It hurts healthcare, like what Wee Kwong has mentioned, because of foreign patients. It obviously hurts retail, especially if you're on the Orchard Belt. It hurts MICE. If you are in a marine Marina Bay, and also, of course, if you're on Suntec, without MICE activity, is conventions activity, then obviously it's going to hurt your business. It hurts casinos, it hurts theme parks, it hurts live events, luxury property. So these border controls actually do hurt quite a number of sectors. So the reopening is of course very important. My last slide on air transport was because of the strength of SIA, we wanted to see how the performance of SIA. As you can see, this is basically the market cap of SIA, which is in red. Then we have market cap of Qantas and Cathay. So we're wondering, is SIA the only one that's outperforming? And it seems to be that way. If you just look at the market cap, SIA now is close to 10-year highs. So actually, the market cap of SIA now is 50% higher than pre-pandemic, which is in a way quite strange. So you could even, I mean, if you take it to the extreme, the pandemic, it was actually good for the SIA's market cap in a way. In a few more pandemics, who knows, we hit the record high, which is about 22 billion. And just as a reminder, we think that it might be overpricing a lot for the recovery. And out of the 8.8 billion rights issue, they've already used like 8.2 billion. So it's almost like 1 billion a month in terms of cash outflow. And we got this question from an attendee, and the book value for SIA, although on paper it's $5, but if you take in the mandatory convertible bonds, it's more likely 360. I know it's going a bit more into details here, but the mandatory convertible bonds have the best of both worlds. It's considered equity, and when you calculate gearing, but it's not counted as shares. So you get the best of, it's like the heavenly product. You get the best of both worlds, the mandatory convertible bonds. Sorry, this one's a bit technical, so some may not understand, but we just think that based on this chart, the market cap is pricing in a lot for SIA in terms of a recovery. The next is telcos. We do show this chart quite a number of times because we thought this is the best reflection of what's happening for telcos. So basically, this is postpaid ARPU, which is the selling price. If you can't really understand this chart, this is almost like the commissions a typical stockbroker has been getting, like us. The decline, at least the price deflation of commission rates. So this is almost the same chart. So you can see that from 2008 to 2015, that's when StarHub and even M1 did so well because prices were just moving sideways. We call them the happy days because there was virtually no competition. Then when TPG came in, you can see the big deterioration from 2016, from let's say 69, 70 to 40. So this is a big amount because what happens is that these are all virtually your profit because your cost is virtually fixed. I mean, mostly fixed because it's all network fixed assets and so forth. So when you have a big price deflation like this, it virtually eats all into your profit. So we call this the TPG effect because before TPG came in, everyone just cut prices before. But then right now, we actually had an overweight on telcos because we thought that the worst was over. But then when we had the border closures, the roaming effect came in as the first bullet point. Roaming is around 20% of mobile revenues. And that, as we all know, virtually disappeared. No one is traveling and no one coming into Singapore or going out. So that when that hits, then 20% of your revenue and probably 20-30% of your profit just disappeared overnight. But if they do reopen, the key markets for roaming will be Malaysia and China. The third point is pay TV is also challenging because of the influx of IoT over the OTT such as Netflix and even Disney Plus right now. But the opportunity for telcos is really not telcos, but it's actually in the enterprise business. Someone like StarHub, they have a really well-regarded cybersecurity business. So any re-rating will be from two parts. When the borders open, and the second part is that if they do list, maybe they list one of their cybersecurity arms, which is a high growth and the multiples for that is high. So that's why we put opportunities in enterprise because that will be one way to kind of re-rate outwards the telcos. Okay, this will be our final slide on sectors before we move on to our stock picks. So this is electronics. Again, electronics is wide-ranging. We used to put in autos, you can put 5G and so forth. But we decided to put the foundry capex chart. So for those who don't know, I know foundry is a bit technical, but foundry is like, if you can recall, chartered semiconductor. So chartered semiconductor will be considered a foundry. So they make the basic raw material, in very layman terms, make the very basic raw material for semiconductor, which is your wafer. So the reason why we wanted to show this chart is that if you want to play tech in Singapore, we think we prefer the foundry equipment makers or part makers, which is like AEM or UMS, although we don't cover, but that would be the cleanest way. So this chart basically shows the capex for Samsung, TSMC, Intel. You can see at the bottom, Micron. So all these are the big foundry spenders. And you can see that 2020 was a good year. There was a big jump from 78 to 90. This is just a proxy. But usually after that, it tends to taper off. But then in 2021, you can see there's another big jump of about 15%. This is big, although it's only 15%, but you're talking about billions. So another incremental 10 billion of new capex. So, and also the first bullet point, both TSMC and Intel already mentioned they want to build more foundries. Like Intel is building 2 more foundries at 20 billion. So what this means is that there's going to be a lot of, to fill the plants, you need equipment, mostly equipment, and most of the capex goes to the equipment. It's not, the land should be cheap, it's more buying the equipment. And as a result, you're going to see the huge demand for foundry equipment or front-end equipment. So that's why we think the easier way to play tech in Singapore will be these foundry equipment makers or part suppliers like AEM or even UMS. And the second bullet point is just to tell you that there's a lot of drivers for electronics, and the lead times for foundries are for equipment makers are widening and widening. And there is a shortage also, of course, for automobiles. So the drivers will be from gaming, all of us, because of the influx of gaming, work from home phenomena, cloud computing, 5G, automobiles, your IoT, like what Aztec makes. And don't forget, because of Bitcoin prices, there's a lot more demand for chips as your video chips, especially because you want to mine more Bitcoin now that the prices are up. So actually, we think electronics should be on a multiple year of growth because there's so many drivers for electronics. Okay, I think we will just, for the next section, we're just going to move on to our stock picks. Okay, firstly, we have our usual model portfolio to review. Our performance was poor, and one of it was because we had Yoma, and Yoma was down almost 50% this quarter. So that took a big hit to our model portfolio. And also we didn't have much cyclicals in our portfolio because we always wanted it to be more balanced. So you can see in our model, we had a lot of yield stocks, and of course we don't calculate yield in our performance, we just measure the capital return. So that was one of the two key reasons for the impact to our model portfolio. In terms of the changes, we added QNM and we took out Yoma. And you can see from the table on the right, which is the performance, we didn't enjoy the big rally that happened in March. We were down almost 3% for the quarter. Although we were up in March, but again, obviously we could have taken out Yoma maybe in February, but we want full transparency. We don't want to just make any changes. We just let if it's a wrong stock pick, we just let it flow through the portfolio. And we always try to give a quote on our performance every quarter. So the quote for this quarter will be, if I was a fund manager with this kind of performance, I think the clients would just let the dogs out if I were to go visit them in their house. So obviously it's a really bad performance considering the market has such a big rally. Okay, I'll move on to some of our picks. Again, I've repeated this many times, Asian Pay TV, and probably a lot of attendees will probably drop off right now because they heard me say so many times and this stock didn't perform. But anyway, we still like this stock, Asian Pay TV. What they do, the first bullet point is they are actually a cable TV operator. Of course, we're wondering, it's such a sunset industry, why do we still like it? We like it because of the cash flows. We like it because of the 9% dividend yield. So the subscribers are stable, although cable TV is down, but I think the broadband is rising, and when we take total subscriber as a whole, it's still flat. So we're not so worried about it. So in terms of the two reasons we are positive on Asian Pay TV is from this chart. So this chart is the dividend. So they were paying dividends, the red bar, 140 million, 110 million in 2015, then another 100 million in 2016. But obviously it was not sustainable. I think you can see the amount of free cash flow they generated was, I think, only like 1/5 of it was about 20% of what they could actually pay. So basically, they were gearing up to pay dividends from 2014 to 2018. One of the reasons was because of this capex line, the capex surge. But right now, why we like it is we think that the dividends have turned sustainable. Now is the flip. Now the blue bar, which is the cash flows, is much higher than the dividends because they took dividends from, they used to pay 140 million. They gap it all the way down to 20 to only 18 million, 20 million. And the cash flows right now they're generating is probably about 50 to 60 million. So they got more than enough to cover the 9% yield. And we just want to remind everyone is what we measure is free cash flow, not EBITDA. EBITDA is not cash because EBITDA means we just want to remind everyone that no, EBITDA means you don't pay taxes and you don't pay interest, which you know is not going to happen. I don't pay your bank, you don't pay the government. So that's why we wanted to make sure that this is real free cash flow, not the EBITDA concept, but against the 18 million dividends. The second thing is, of course, optionality on the 5G when 5G rollout. It should happen this year, but again, even without that, we are still getting the 9% as we wait for this opportunity to arrive. Okay, I'll move on to the next stock, which is ComfortDelGro. So for ComfortDelGro, the first bullet point, okay, the table on the left is just basically the Singapore taxi fleet for maybe the last 2 years. Of course, because of the pandemic, you can see from April onwards, the number of taxis out there just kept down. Even for private hire cars, it's the same phenomenon. But the good thing right now is at least there's some stability in terms of the fleet. But some of the reasons why we like it is that when it exited this pandemic, actually the balance sheet came out stronger. They actually generated more cash during FY20 than in FY19. Part of it was because they reduced capex, and part of it, of course, there was some government subsidies. The other driver to share price will be the new real financing framework. Yeah, it's a big term, but actually what it means is just that the government will own the trains, and then Comfort or SBS Transit will be just paid an amount for running. It will become just an operator rather than an owner. The key point from this new deal with the government would be, if it happens, of course, would be it will reduce ridership risk. So if there's no one sitting, goes to the train and the train just goes in circles, it doesn't really bother SBS because I'm being paid to operate. I don't have to worry about ridership. The other third point is that we like it because regardless, Comfort still has a 60% share in taxi and buses. Australia and UK profitability will improve now as the pandemic kind of ease off. And the other point is that Grab is still a formidable competitor, regardless. But we still like it because it's our proxy to a recovery in transportation. We have a buy call. The next is PropNext. So PropNext has done really well. It's almost reaching our target price. So eventually we'll have to take this out. But for one of the reasons has been the property transactions. So the table on the left shows the amount of transactions, both new and resale. So last year we had, if you look at the 2020 table, we have like 20,000 of transactions. Roughly split, new is about 10,000, resale about 10,000. So you can see that even though we had the big recession, on paper at least in Singapore, the number of transactions in property transactions has been resilient. So that's the first point. The second point is we always like PropNext because of the market share. So they have like 50% market share in all these transactions. And one of the reasons when we look for a Singapore company, because although our market is small, we only look for companies that have got a big market share, and that will attract us in terms of writing, initiating coverage and so forth. The other thing why we like it is because of the 33% ROE, and actually the ROE should be higher because most of the capital is all cash. For this year in 2021, the driver for volumes should be private resale because of the prices are because prices for resale market has been there's still a big gap between resale and new, and that's why one of the reasons why the volume should be high, will pick up in 2021. And of course, HDB and private will also be stable. Okay, the other stock that we will just discuss, I don't cover it, will be my analyst Jackie, but she can't attend with us, will be First Sponsor Group. This company might be a bit alien to most of us, but they do have rich parents, so that's actually a positive. Okay, some may not be that rich as a year ago, maybe, of course, it's talking about Taitang and CDL. But what we like about it is that they actually capture the whole development chain. For those who don't know, Taitang actually owns like 4% on UOB, and they actually collect 70 to 80 million dividends a year. So all they need to do is just make sure they receive the check and just bank it in, and they will get 70 and 80 million a year doing nothing. I'll just make sure that the check clears. So that's why we call them the rich parents. The reason why we like this is because first sponsor is not only the financier, they also develop and they're also a landlord. So we like it because they have this financing business in China. It's a bit alien for most of us, but because you cannot actually borrow money to buy land in China, officially at least. But right now, so that's why they actually can lend to developers, and especially right now, we're expecting the loan book to grow about 18%. Because especially right now, there's a bit more tighter financing in China. So there's one growth driver. The second growth driver for us is they are in this very hot Dongguan market, which is in the Greater Bay Area. Dongguan is so hot that even if you want to buy a property, you queue, people who are willing to pay money to be in the queue. That shows how hot it is. And they have about 900 million of unrecognized revenue. Their revenue last year was about 50 million, but 900 million, because some of it is through associates. But they've got enough revenue probably the next 2-3 years to show very robust earnings. And there's another 4 billion of GDP to be recognized, to be launched. So about 3 billion net, because it includes the 900. So we think that the development business will enjoy very strong growth. That's the second reason. But there is a weak spot for them. The weak spot is the European hotel properties. So because of the pandemic, so that is the one that's dragging earnings, but not the European office. That is still doing very well with positive rental reversion. So that is why we like it, because it's a unique property developer. It not just develop, but it also does financing, which is one of the most profitable segment among all their business segments here, because of the margins, the higher margins at the financing. Okay, I'll move on to the last one. So this will be the last one for me before we move on to the other analysts. Will be Penn United. So we just initiated. So for those who not sure, Penn United actually does ready-mix concrete. Let's think of it as wet cement, and easier way to describe it. So the other thing is that because they have like around 40% market share, and basically this is one way to just play the bounce in the construction sector. You can see from the table on the left, construction, the blue chart, the blue line, which is contracts awarded. So last year was a very bad year for construction, because the amount of contracts awarded was roughly back to 20 billion, and that you can see is like a multi-year low. So what we're saying is that we think there's a big recovery coming up, at least 30%. And if you don't believe me, because it comes from the BCA itself, so there's going to be a big bounce in construction activity, which is obvious because last year everything was shut down. So we're buying on the bounce. And we also like it because the third bullet point, there's a lot of barriers to this business. If let's say you decided to want to compete with them for whatever reason, firstly, you need to build silos, which is you need to have a silo which is like ocean fronting, like pristine like location, because you need to get all this cement, you need to come by ship. So you better have a nice port there to collect the cement. Then you need to get batching plants, which is costly, and the authorities don't really give them. Batching plants means to mix the cement and the sand. Then, of course, you have to compete against this dominant guy, not this really high market share guys with 40%. So try doing that if you want to compete. And not only that, you need a very reliable upstream, which is cement, and also a very efficient downstream. Because once the cement is made, many may not realize, but you need within 2 hours, you better deliver this wet cement or RMC. Otherwise, this thing will just harden in your vehicle. But what it means that you need a very efficient delivery system to go into this business. So that's why we like it too, because there's just a lot of barriers for anyone to try to enter this business, and you're going to get a construction recovery. So I think that's Then one other stock for me is Q&M. So Q&M is another new initiation. I hope most of us would know. But Q&M is a dental clinic, very simple. So you can see from the table on the left, these are the number of clinics that they have. So our thesis for them is simple. It's just two theses. So the first one is the search in new clinics. So in the past, they started off by acquiring clinics, but that was just to get the big base. But since 2019, you can see they jumped from 90 to 111 clinics. In the past, they were just adding maybe 5-6 clinics, but from 2019 2019, the strategy was to grow organically. It stumbled in 2020 because of the pandemic. But right now, we think they are growing their number of clinics by at least 20% a year. And obviously, when you grow clinics, then that will give you growth. And very important, it becomes sustainable growth, because once you get a clinic, you're not going to shut it down the next day. So that will give you growth that's sustainable. The other thing is that they have the brand name, they have the location, and more dentists want to come onto the platform, because most just want to focus on running a dentist and not do all the admin stuff, back end stuff. And also they're also beefing up their recruitment resources to kind of grow the number of clinics. And the other growth area, which is the fourth bullet point, is the PCR testing. So this is the new area for them. So as we all know, the COVID-19 PCR test, not only are they selling the test kits because they have a stake in a company that developed the technology from the test kits, but the more important is the lab testing. So lab testing is tough, because lab testing, you need approval by the ministry, and because this is a contagious, this is a virus, so they're not going to give approvals that easily, because there's a lot of risk if there's any mishap at the lab. So it's very hard to get the lab license. And of course, you also need the equipment, because you're doing a molecule kind of testing, not testing of blood and so forth like other labs. So that's why we have a buy and we have a dollar target price. It's actually 73 cents, not dollar. That's a typo there. I think that's it for me. I think I will move on to Wee Kwang for the next stock.
Okay, thank you, Paul. Okay, so for IX Biopharma, basically they are an they are a drug maker. So for them, they built their entire brand around their wafer-rich technology, which is actually something that is very different from other drug makers. So what you see is that their wafer-rich technology is actually like a platform that allows other drugs to be kind of like a repurposing of other active drug ingredients. So what happens is, we know that there are some drugs that are patented, and once they actually go off patent, if they're actually able to put it onto the wafer-rich technology. So the wafer-rich technology is actually the technology that allows drugs to be delivered underneath your tongue through the blood mucus, blood vessels underneath your tongue, so directly into your bloodstream, which is much faster and more effective as well. So if these drugs are actually able to be repurposed that way, it actually extends they can actually become a new patented drug. So basically their useful lives become longer again. So this actually gives them a lot of room, runway for growth itself. So for them, this is why is this wafer-rich technology so important to them? Because under this technology, they have already come up with usable drugs that are out in the market. And for them, the upcoming, there is two blockbuster drugs that they have under their belt that is waiting to be out licensed. First of all is their Wafermin. Wafermin is actually their ketamine wafer. So if you actually see this deal that they are actually waiting for Wafermin itself is actually on hold for maybe about 1 year due to the pandemic. It has been put on hold, and currently what they are waiting for is actually a balance between rushing out a deal or getting the best deal out there. It is they already have a prospective people who want to out-license the drugs from them. However, what they do see is that there is no need to compromise on rushing out a deal right now, because they do see that this ketamine wafer is actually is a game changer in the pain management market. So this is something that will probably be delayed for a while, but it will be very big for them in terms of the size of the deal. So when it comes to deal making, usually how a typical drug deal is that you have an upfront fee, you have milestone fees, and you also have royalty fees as well. So this is a very long runway in terms of cash flow for them as the out licensing partner. And what happens is the size of the deal, how big the deal is, will depend on how novel the drug is. For ketamine itself, it is something very new, and there are no competitors out there in the market. So this will be very, very, very big for them. The second drug they actually have is Sativa, which is like a sublingual cannabis wafer. And it's currently being sold in Australia already and UK as well. Of course, in Singapore, we do not hear much about cannabis because of regulations and a little bit of stigma out there. But if you actually take a look elsewhere, the deregulation of cannabis will actually help them because of the technology that they have. And for Sativa itself, they actually managed to split the the active ingredients of cannabis. So in cannabis, what you get is there is two active ingredients. One is called the CBD, and the other is called the THC. And the CBD is the one without the psychoactive ingredient, which means that you don't get high on it. And this is the one that people are generally more accepting to take in terms of as a medication. So what they do have, the sativa, is the one that has incorporated CBD itself. And right now, with all the bottom-up, the grassroots efforts in pushing out proper regulations for cannabis market, now we see that this will be a huge thing for IX Biopharma as well. And even if so what they have is a very strong pipeline of drugs that they have, and of which these two are the most kind of like a blockbuster deal for them. And even if you say that, you try to be skeptical, you remove that, all these drugs that they have, these deals that they have are not going to flow through. What we do see is that their current portfolio of drugs that they have, which you can actually see in the bottom left-hand table, some of them they are actually in production, and they're actually being sold elsewhere, and they are actually being limited by their manufacturing capacity. And right now, they are actually expecting a 6-fold increase in their manufacturing capacity, which will help to lead them into profitability even as early as end of financial year 2021. And as a result, these two blockbuster deals that they have will be something that pushes them above. But even on the baseline itself, what we do see is that they have a very strong runway for growth, even with even if the drugs that they have. And if you actually take a look, basically the wafer seal and seal cap is just basically the active compound inside is just what you see in your Viagra. And they do have their health supplements line as well. They're selling basically selling very well in China as well. So for them, we do have a buy rating with a target price of 45.5 cents. And that's it from me for stock picks. I'll now hand the time over to Natalie.
Hi, thank you, Wee Guang. Okay, so starting off with my first stock pick, which is Fraser Centrepoint Trust. Okay, we like Fraser's because first of all, it is a retail operator, retail landlord, and in their portfolio, it's largely suburban malls. That means it's your malls that are located in the heartland area in the north, like the Causeway Point as well as your North Point, etc. So they have a captive catchment of heartland population. Okay, and so what we saw for FCT was that they remained very resilient through the cycles, especially during the circuit breaker period 2020, where the suburban malls actually displayed an outperformance against the central malls. And this is largely due to the recurring necessity-driven spending that happens at the malls from their essential services trade, which actually contributes about 54% of the GRI. So some of these essential services are like your F&B, your pharmacies, your Guardian, Watsons, whatnot, as well as some of your supermarkets. Okay, so this actually provides a very recurring spending from the catchment population, the heartland area. Okay, second of all, of course, that we expect an increase in catchment size to actually lift tenant sales. So FCT will experience an increase in catchment size from 3 areas. First of all, of course, permanent hybrid work arrangements that will increase the daytime population around their malls. Second, of course, it's the increase in the number of HDB units that are being built in the north area. It is projected to increase by about 68%. So this can be seen in the graph on the left-hand side, where you see that their dominant and larger malls, Causeway Point, North Point, and Waterway Point, the number of HDB units, flats that will be built in these areas is going to increase significantly. So that will bring with it additional footfall to the malls. Third of all, of course, is the decentralization plans that the government has for Singapore, which will actually create commercial clusters in the north. That means near the Woodlands area, which will benefit your North Point and your Causeway Point. Okay, so of course, there's we do believe that the demand for space at suburban malls will likely remain strong due to this captive population, and the larger and dominant malls will be prioritized amidst retail consolidation as well as expansions. So with that, our target price for FCT is actually $2.79 with a DPU yield of 5.4%. That brings us to our next counter, which is Manulife US REIT. So for Manulife US REIT, they are a US office REIT. They hold grade A and trophy assets and across the United States. And we like Manulife because of their defensive portfolio attributes. First of all, they have a long WALE of about 5.3 years. This compares to some of our Singapore-focused office REITs with WALEs about three years. So because of this 5.3-year WALE, that actually means that the lease expiries, especially for FY21, is actually relatively low at 5.8% of GRI. Additionally, about 96% of the leases actually have rental escalations built into them. So it could be periodic rental escalations every 3 to 5 years or annual escalations. So on average, that's about 2% per annum. And this is basically an organic growth for the rents in the portfolio. Occupancy remains relatively high. It has come down since pre-COVID times. It is currently about 93.4%. It's still above the market average for the US office assets. Okay. So the next point is subleasing. So before I talk about subleasing, let me just explain what it is. Okay, so subleasing is, for example, if your building is 100% occupied, it means that the leases have been committed and the occupant and you are receiving rents for this all of the space within the asset. However, that in the US and as well as in Singapore, tenants actually do have the option to sublease their space, meaning that I could take maybe 20% of the building, and let's say I decide to move my operations to a more maybe work from home or a hybrid, and I want to reduce some of my space. I can actually take some of the space that I currently lease and I can lease it back to the market. So this subleasing of space actually competes with the asset for potential tenants, and also so that's not good for the market. Whereas where we see in Manulife, and this is one of the data that's coming up from the US, that subleasing has been on the rise in the US, and this is however, we see that for the cities that Manulife has assets in, such as in your graph on the left, you see the cities that Manulife has assets in: Atlanta, Los Angeles, New Jersey, etc., Washington DC. The subleasing in these markets actually averages 11%, which is substantially lower than the notable gateways of San Francisco, Seattle, and New York, which subleasing is currently high at almost 30%. Okay, so despite being located in these cities which experience a lower subleasing, the subleasing within Manulife's assets is even lower at 3%. Yeah, 3.3%. Okay, so that is another positive that we see for the REIT. That means basically the tenants still want to be at the asset and are still leasing out and occupying them. Okay. Of course, another factor that we like is that the office using tenants in the US, the sector remains very resilient. Rent collection is high at about 99% in FY20. And the US, of course, as we know, is a mature and remote working adjusted office market. So we actually expect less impact from work from home adoptions as compared to in Singapore, where you dominantly office working society. Yeah. So for Manulife, the yield is still relatively high at about 8.9%. Okay. Next slide, please. Now we go on to Ascott Residence Trust, ART for short. So for Ascott Residence Trust, it is a hospitality REIT. So they own service residences, business hotels, as well as most recently they have also expanded the asset class to include purpose-built student accommodation. So more on that later. Ascott is the largest hospitality REIT on the SGX. Also has a lot of assets by asset concentration risk is actually low because they have more than 80 assets. And we like them because of their diversification by lease type as well as by geography. So there are 3 different lease types that Ascott has in their portfolio. So just looking at the pie charts on the left side of your screen, okay, they are the master lease, the MCMGI, which stands for management contracts with minimum guaranteed income. So these 2 lease types are the stable lease type because there is some sort of a floor revenue. Okay, so master leases and MCMGIs, and then there's the variable component or your growth component. which is the management contracts. So the management contracts revenues are more variable in nature because they are dependent on the occupancies as well as the room rates that Ascott can charge for the available rooms. So that's it. Because of this diversification of lease type, we know that 2020 was not a kind year for the hospitality sector. Due to the travel bans and what have you, occupancies was actually relatively low, around 40 to 60% for the hospitality sector. However, because of this diversification in lease type, we see that while the management contracts portion actually did become smaller, contributing only about 34% of the gross profit, the master leases and MCMGI revenues did not fall that much, and therefore it compensated for it actually mitigated the decline in the gross profit. So that being said, Ascott actually they try to achieve a balance between the stable as well as the growth income. They try to achieve a 50-50% split. And moving on into FY21, we can expect that master leases and MCMGIs will contribute a smaller portion. It is slightly under the 50% target, but the recovery will come from the management contracts, which we expect them to contribute almost 56% of gross profit. Okay, so we also expect Ascott to have a potentially faster recovery than its peers, and this is because 74% of their assets are actually in countries with larger domestic markets, such as your China, Australia, Japan, US, and UK. So as the vaccine rolls out globally and as immunization rates go up, we expect that domestic travel will pick up faster, and therefore it will recover faster than international travel. And because of this large exposure to countries with domestic markets, we can expect that Ascott's recovery will be faster than Singapore-focused hospitality REITs. That said, Ascott is also trying to grow their portfolio and embellish it with more stable kind of leases or asset classes, such as your PDSA, your student accommodation assets, and your rental housing. So these type of asset classes, they actually have, they're counter-cyclical. They have maintained high occupancies even during the COVID period. So occupancy was high at about 85%, even in 2020. And they are intending to grow this stable asset class from 7% currently to almost 15%. So that will actually help to bring up the portion of stable leases and also provide more stability for Ascott moving forward. The last point I'll touch on quite briefly. Currently, as it stands, their balance sheet is still very stable, very strong, because they have sufficient dry power as well as liquidity reserves. So they have almost 2 billion debt headroom for acquisitions, as well as additional cash facilities, 1 billion of them, to cover almost 3 years of fixed working costs. Oh, sorry, I missed out one point here, which is asset recycling. So even during 2020, some of the assets managed to command very good exit values. So they were sold at almost 60% above book, and they were reinvested in higher yielding assets. So this is of course is like an upside for the REIT where you're still collecting 4%. Actually, it's 5%, more towards a 5% normalized DPU yield, and then you still have a potential kicker of asset disposals and recognizing unlocking these kind of values. So that's it for FY21. The DPU yields for Ascott is going to be about 4%, and we have a buy call on Ascott. Moving on to the next slide. So this is my last counter, and this is CapitaLand Limited. So CapitaLand is, as we know, they are a property developer, and they are very large and diversified. So their asset classes, of course, include retail, commercial development, which is your residential strata kind of assets, industrial. Okay, so because of their diversification and their earnings stability, we prefer CapitaLand, and so some of the earnings stability actually comes from fee income. So these fee income, these recurring income are the fund management fees, which are the fees collected from the management services provided to the REITs as well as their private funds. So currently there is almost 77 billion worth of funds under management being managed by this fund management arm of CapitaLand. Second, of course, it's the management and franchising fees from their lodging platform, which is the Ascott Limited. also recurring in nature, and stable. And of course, lastly, it's the investment property. So CapitaLand actually holds some of the assets on the balance sheet, and this will earn recurring revenues, rental revenues over the years. And this investment property actually contributed almost 53% of revenue for FY20. Yeah, and of course, 2020 was a worst hit year. So therefore, on a more normalized terms, actually IP will contribute almost 2/3 of their gross total revenue. So the demerger that was announced earlier in March will actually help to pivot the new entity, which is CapitaLand Integrated Management, to be an asset-light and growth-focused entity. But even with this, even before this demerger, CapitaLand has very clear goals in terms of driving the amount of funds under management. So on the graph on the left, you can see that this is the amount of funds or assets that the fund management business managers. It actually grew substantially in FY21 due to the acquisition of Ascender Singbridge. And then after that, they still managed to increase the amount of AUM by 7.5% in 2020. And the target for this fund under management is actually 100 billion. And the target is for 2024. So basically, by growing the base of assets under management, the fee, which is a percentage of the assets under management, will also grow. Okay. And similarly, they also have this very strong, clear targets for their platform, for their lodging platform, and they want to grow their number of keys under management from almost 130,000 keys to 160,000 keys in the next 2 years. Okay. And lastly, of course, they have very clear targets for asset recycling, where they want to unlock or rather dispose of non-core assets and actually try to capture more upside in new economy assets, such as your business classes, business parks, and your logistic assets. So with that, our target price for CapitaLand is $4.32, and this is factoring in as well the valuation from the demerger. Yeah. So and for CapitaLand, the DPU is about 2.7%. Yeah. So that's all for me. I'll pass the time now on to Terence for Keppel.
Yeah, thanks, Natalie. So for Keppel, I think most of you will be familiar, but this is really a conglomerate, and I think the most important thing to look that most investors are looking out for now is the sale of the Keppel O&M unit and the Keppel Logistics unit. So I think everybody is looking out for when they are actually going to dispose of these 2 units. The rest of their business, you can see, because they are conglomerate, we assign different valuation on their different business units. But the one that is really in focus right now is the O&M unit, and so you can see this on the chart on your left-hand side. What Keppel O&M has done is to really split the Keppel O&M into 3 different units. You may be wondering why they split it into 3 units. Actually, it's really just to make it simpler for them to divest of. There's obviously different options on the table that they are considering, but they are looking to divest of each part. But the 2 parts they are looking to probably divest is OpCo and REITCo. You can see Development Co is really they're just developing the rigs under construction. So it's a very transient structure. Once they've developed all the rigs under their order book now, the development co will dissolve, and all the rigs will then be transferred into REITCo. So they hope, I think what they hope to do is try to dispose of the entity as soon as reasonably possible. Then at least they remove that overhang. We see the disposal of the O&M unit and logistics unit as obviously being very positive for the group in general, because these 2 are the guts for the Keppel group. And the disposal of the two units will transition Keppel away from the rig building business, which is really a very sunset industry, into an asset-like business, similar to what Natalie mentioned just now, which the CapitaLand group. So move from this very asset-heavy business into a very asset-like business with a respectable 15% target ROE for the entire group. So our valuation on Keppel Group is based on the sum of the parts because it's a conglomerate after all. So we valued the O&M unit at 0.6 times book value, which is actually a discount to peers really. And then the property segment at 40% discount to RNAV, the infrastructure and M1 business at 12 times FY21 earnings, and their Sino-Singapore Tianjin Eco-City project at 1.5 times the book value. So our TP is actually $6.12, which actually translates to about just 1 time of their historical book value, which is where they historically trade at. Now, let's hand back the time to Paul to just wrap up the whole entire strategy note today. Over to you, Paul.
Thanks so much, Terence. I think that comes to the end, and for once, maybe we finally have some time for questions. The previous sessions we did, we always just ran out of time to do questions. But just for some concluding remarks, since I think most of you can't remember what we all just said, but for those who can still remember, I think basically what we're trying to say is that the backdrop for equities is still favorable. Economic growth is building momentum, and you have low rates, reopening base effects, and there's another stimulus coming underway. There will be some volatility from the US and employment data, but I think the trajectory is still upwards. And just a reminder that the Fed is just reluctant to move for monetary policy at least this year, and that is our target price for the STI. Okay, just a refresh. This is our equity team. So if you have any questions, feel free to ask all of them. Ask all the analysts here. Okay, and oh yeah, actually, there's another. And also, this is our WhatsApp. If you want to have any report sent to you via WhatsApp, just type into this subscribe button, and also all our reports are in this website called Stocks BNB. So I think we can move towards the Q&A, and I think a lot of them are banks, and I'm going to stop sharing right now. Okay, Vikon, can you go? I think we will take the questions from the Pigeonhole, and we will try. Sorry, some of you may not actually be able to read the questions, but I think Vikon can just read them out. Vikon?
Yeah. Okay, thanks, Paul. I'll just be reading off some of the questions that are for me. I think especially with regards to the banking questions first. First of all, is that DBS is consistently trades at a premium to the other two banks. Do you think this is justified? Will the other two banks play catch up? If yes, what are the potential catalysts for UOB and OCBC? And definitely, I think if you take a look at the price to book value, DBS definitely always trades at a premium to the other two banks. Whether or not this is justified or not, basically they are the biggest bank in Singapore. So if you take a look at it, when people want to come into Singapore, this is one of the counter that they will have to enter definitely. But however, of course, for ourselves, we do think that UOB and OCBC will play catch up in terms of the valuation wise, and in terms of stock pick within the sector itself, for the banking sector. Personally, I am favoring OCBC in the short term. What we see is that for OCBC, there is a few things going for them. First of all, in terms of recovery in economic conditions, definitely their stake in the insurance business will definitely help them in the short term, and also the wealth management business will also grow as well. Also, if you take a look at historically, their scrip dividend that they actually issue is always traded, is always a 10% discount, and when they actually remove this 10% discount, what you see is that the issuance of new shares by OCBC will taper off, and this will help to improve some of their share price, kind of like that, how the share price will move in the short term, because you do not get any dilution from additional issuance of shares itself, and therefore the ROE will not get as diluted as what we see previously. So second question for the banks, do you think there are more upside for the three banks in Singapore, or have all the good news been priced in? Definitely, we see, of course, for the banks itself, there is a lot of pricing. We see that the first quarter performance by STI mainly generated by the banks itself. But in moving forward, I think that there is still some upside in terms of valuation, especially in terms of playing catch up for UOB and OCBC. And secondly is, if we want to contextualize the allowances that actually provided for in 2020 itself, actually, this is like a playing safe. If actually moving forward, the economic conditions turn out to be better than expected, what we can get is actually an upgrade of all these allowances. And when the banks actually do upgrade allowances, of course, we are not expecting this upgrading to come in 2021 because they feel that some of the credit migration from healthy loans to non-performing loans might not have fully been observed yet. However, if we actually move in 2022 and they feel that, really the worst is over, that's where you get an upgrade of allowances, which will see these allowances actually flow into their earnings in the future. So this is some positive upside that we might see moving ahead. Yeah. So I think these are the two banking questions that we get. Yeah. So let me see whether there are any other questions. And in the meantime, if there's any other questions, I'll just hand the time over to my colleagues as well.
We'll just try to take the next question, which is, I'm not sure if we can flag it up here, but anyway, if you can't, let me just read it. If you have to choose between BRC and Pan United, which one will it be and why? For construction companies, apart from material suppliers, which do you recommend? Terence can just give some general comments because Terence covers BRC, but I guess one advantage BRC has is if you thought Pan United's 40% market share was good, I think you haven't seen BRC's market share, which is even much higher than 40%. I hope I'm allowed to say that. But anyway, for construction companies, we rather not play construction. At least for us, construction is very competitive, and you ultimately still have to guess who is the winner. So like we always say, we prefer building materials because we don't have to worry who wins. Whoever wins, the material guys will win because you got like 40% market share or more. But for BRC, I think I'll hand it over to Terence.
Yep, thanks, Paul. So like what Paul mentioned, for BRC, they are a very clear beneficiary of the construction sector recovery. I think for both PenU and BRC, they're both going to benefit from the construction sector recovery. But more so BRC because they have a 70% market share in the entire market. So that's more than 2/3 of the whole entire market already that they will get. So for FY21, we are forecasting that they will be paying about 7% dividend yield, and they are also just trading about our target price of about 190. They are only trading about 10 times of their FY21 earnings. So we see BRC Asia as being very cheap at this point. Yep. So that's all from me.
Okay. Can we flag the questions on the pigeonhole? If not, we will just run through the next question. I think it's capital and I think. Natalie, your question on.
So the question from our Q&A tab, capital stocks have risen some 20% since the restructure. Do you see any more runway for the price to rise this year? So as of Friday, I think the price was about $3.77, if I'm not wrong. And our target price is $4.38. So this $4.38 is actually even higher than the implied consideration value of $4.10. This is because how we have come up with this valuation is because we have taken into account the re-rating of the new entity, which is CLIM, CLIM for short, a real estate investment management kind of asset that usually trades at a premium to NAV. Okay. And we have taken the re-rating of that stock as well as applied a sort of a probability to assess whether or not the demerger will take place. So based on this forward-looking value of CLIM, as well as the consideration of 90 cents in cash and 0.155 units of CICT, so that actually gives us a target price of almost $4.38. So in terms of do we see more runway for the price to rise this year? Yes, the answer is yes. Clearly, because our target price is still sufficiently or significantly above the current market price. So that's it for my question.
Okay, let's run through the list again. The other question we have is on iFast. So let me just read that out. iFast has outperformed SGX and UOB Kay Hian by a mile. Yeah, I think a mile is understating it. It's like probably the space time, the distance between Earth and, because it's like 2 billion now, the iFast, and its valuations are very rich. Do you think this is justified? Vika, you want to do or you want to try or you want me to do?
Okay. I'll try to take it. For IFAS itself, definitely some of the things, I think a lot of it is riding on the fact of the growth factor. For them, they do have to get their contract with the Hong Kong MPF, which is like our CPF board. So everybody who kind of trades using their MPF will need to go onto the IFAS platform itself. So this is something that they have going for them. Of course, what they come in is as a contractor. They will get a kind of like a fee from this deal itself, but we do not know how much they will get from it. So maybe the valuations are running ahead of themselves, but we do not have much more clarity when it comes to that. And compared to, I think when you compare it to SGX and UOB Kay Hian, definitely the valuations will seem a little bit richer. Yeah. I will take some questions on the healthcare sector as well. I do see some of them. Just let me. I think one is on Raffles Medical. Just give me a moment. Raffles Medical was once a market darling. Do you think the China hospitals will eventually help to re-rate the stock? If yes, what time horizon will it require? Okay, definitely. For Raffles Medical, the play for them is that we know that the demand for healthcare is back, and especially in China, if you take a look at, they are already kind of in terms of growth and economic recovery, they are much far ahead of the other economies. So definitely, Raffles Medical will benefit from this. However, what we see is that in the short term, definitely because their Shanghai hospital is launching, and they do have their new Beijing hospital that was upgraded from just a clinic itself, is also launching. There is this gestation period that we see will kind of replicate some of the performance of the Chongqing business, or what we saw over the past 2 years. For the Chongqing business, this year is when they expect to break even. But if you think of how moving forward, how long it will take for them to see the positive effects coming in from the 2 new hospitals from China, it will take about maybe 1 to 2 years. Yeah, definitely, where I think they will get a strong re-rating as well.
Okay, thanks. Because there's another question on I think it's on Thai bev. So let me just try. I have looked at China beer companies. If one looks at their adjusted core EPS growth, it is single digit like Thai bev, but China beer companies can trade at 30 times PE, but not Thai bev. Why not? I'm not sure for China. For the beer companies, yeah, as you know, Thai bev is going to list their beer business. We did some back of the envelope computation. So even at the listing, the impact, the EPS impact is very small, and even the re-rating is very small, because the contribution from the beer business is diluted by interest. I think whatever profit they make from Saigon beer, it just disappears because of the high interest. I think they're, I don't have the numbers offhand, but I think they're paying interest about maybe 200 million a year, roughly. And so whatever profit you think you made from Saigon just goes into paying the banks. So maybe the banks are the beneficiaries of the acquisition. But anyway, even if we do the IPO, we did it, I think it's in our report, the impact is probably about 3%. So it's quite insignificant impact from the listing. It will help de-gear Thai bev, but in terms of moving the numbers, it won't. And that's, we assume the beer companies are trading at 30 times PE. As to the question why Thai bev historically has been on 18 times, and because the growth profile for Thai bev is a bit slower, although they have like 90% market share in spirits, and that's like about, I don't think any other company has this type of market share, but I guess the growth profile may not be as strong as the Chinese beer. I can't. The reason I hesitate to answer because I don't really know the outlook for Chinese beer, so I can just look. I'm only peering from one lens, so I don't have the other part. So that's my own view. Yeah. But thanks for the question. Let me quote the other one with the highest vote is the Yoma question. Yoma is covered by my analyst, sorry, our analyst Jie Hui, but she's not here. So let me just try this one. For investors who don't own Yoma now, what indicators will you monitor closely for entry based on your experience and tracking of other politically hit stocks in the past? based on my experience, which is bad experience on politically hit stocks, I don't, I mean, to be fair, I don't think there's going to be any positive near-term outcome. I mean, the way things are going is worsening day by day. But if I wouldn't look at indicators, I mean, there's really no indicators. You just have to look at the political situation, unless there's some amicable solution, which unlikely is going to be, looks more likely to be one big major negative event rather than one major positive event. I'm not into going to the politics here, but I guess if they're going to have another elections or so forth, then maybe that can help. But at the looks of it now, it looks like it's getting worse by the day. That's why we kind of downgraded the stock and took it out. Just as a refresh, in our report, we actually mentioned specifically why our investment thesis on Yoma. And that was because they had a KFC franchise, and we know how profitable that is. They had a 10-year land bank to develop, and they had a profitable fintech where Alibaba or Ant Financial was going to inject like 30 million, and then they had Ayala coming in to invest in 100 million. So our investment thesis was we don't think it was wrong, but we sacrificed. When you play emerging markets, you sacrifice growth for, I guess we all know now, political risk, and that didn't pan out. So that's why we are still a bit wary of Yoma right now. Nothing against on the company, but just as you all know, you can read it from newspaper, the politics doesn't seem to be improving. It seems to be worsening. Sorry, I think it was a long answer to the short question, but anyway, that's our view. Let's move on to. There's one question on SPH. Has SPH gone ahead of its fundamentals that with too much optimism over potential restructuring? We don't cover, but the book value is still 20. I think the share price now is 170. Maybe a little bit of over optimism, because even at the Kupang, because they have this 100 million exposure in Kupang, but they've really taken up maybe about 80 million of the market cap in their books. So maybe another 30 plus million, some back of the envelope numbers. I think that the potential for SPH is also on their data centers. They're going to build data centers now it's like almost like a gold mine in Singapore, because there is no more data centers, and I'm not sure, maybe theirs is the last data center, and there's going to be a 1 billion data center. And Neti told me that the Keppel DC REIT is trading at 2 times book, so you can imagine how valuable this data center is. And also media is also recovering, and although it's structurally declining, but I think although we think there's a bit of optimism, but we actually think that there could still be some a bit of rally, because there's a recovery play also inside SPH, and also it's still trading like 30-40% still below book. And the book is also understated because they also have like huge good class bungalow portfolio, which a lot of hidden assets inside there, and which the book don't reflect. But so I think near term there could still be some momentum in the stock. I mean, this is just my guess because we don't really cover. So I'm just looking at the questions. I try to take 2 more then so that we can end it. Actually, there's so many questions. But let me just try. Is there any reason to choose ComfortDelGro over SBS Transit, besides the fact that the former is larger and more liquid? Yeah, actually SBS Transit is like the better parts. It has the best parts of Comfort without the taxi. I mean, SBS Transit is obviously a better invest. If you look at it, I mean, because they have the trains and the buses, and you don't have the taxi. But the problem is that, of course, like you mentioned in the question, it's larger and it's more liquid, and everyone will just play the larger and liquid names. So that's the reason. And SBS Transit, you're going to get the whole new rail framework, and basically going to de-risk the whole train business for them. So SBS is fundamentally a much better exposure, but provided you can get any shares, because there's no liquidity there. Quickly run through the next one. Can you name some oil price recovery plays listed in Singapore? I can name 3, REX, and REX. Because if you want to talk about exposure to oil price, that would be the main one would be REX, because the rest all just died. And we look at Chris, I think like Chris Energy, right? I think those are all either delisted or in liquidation. Of course, the other one would to play would be like Capital Corp and so forth. But without trying to speak on behalf of Terence, but I think the REIT will take some time to recover. Even if oil price increases, there's still a lot of REITs out there, which is I think cold stack or hot stack. It probably take another few years before you're going to get. I wouldn't say get another REIT order, but even if there's a recovery in oil price, then exploration rate has to rise. And then even you explore, there are so much inventory out there for rigs. Then even after that, only you are going to get the rig order. So I think buying the yards for that is a bit of a stretch. But for pure oil price, from top of mind will be Rex for me at least. I'm not sure if Terence, you want to add anything. Yeah. Okay.
No, nothing to add. Yeah.
Okay, sure. In view of time, let me just take. I'm not sure. We still got lots of questions. So as usual, we probably have to reply you by email. Let me just see what other questions there are. Okay, I think we've taken. Okay, there's one last. I'm not sure how much time we have, but there's one more on Straits trading. Let this be the last one. Straits trading has gone up a fair bit. Do you think the potential ARA IPO has been priced in, or do you think there's more upside and other catalysts? I don't have the numbers in front of me, so I can't really share, but I'm not sure if the ARA IPO is I'm not sure how soon would that be, but I really without the details, sorry, I can't really answer this that clearly. But actually, for me, I like the tin business because tin could be the next substitute for could be used heavily in EV batteries. So actually, I like their tin business rather than the other parts in a way. Yeah, I need to get back on you on this because I don't have the details. We did a report before, and if you refer to the report, we will give you more. They have more details on the potential ARA listing. I think we need to stop soon. We need to move on to our US analyst.